Welcome to Digital Asset News. Take the top stories in cryptocurrency and digital assets, break them down to bite-sized pieces. Today, we've got some interesting stuff. First up, we've got a report that the traditional market is taking a tumble based on earnings. This is a report by two different analysts also. Why the recent strength of the market is an ominous sign of what's next, and Bitcoin-based portfolio ousted by BNB-based allocation in 2019. And this is just the tip of the iceberg about what we're going to talk about. So let's jump into it. First up, let's take a look at the markets. Well, first of all, we were above 200 billion as far as the market cap. Now we're at 192 billion. Looks like Bitcoin took a tumble, 6720, Ethereum 156, and so on and so forth. So everything's down across the board. Who knows what's going to happen, but maybe we can take a look at different happenings that are going on right now. We can get a clue. So first up, there's two different analysts that were talking about what is happening as far as the market has taken a little bit of a tumble and weak economic data, which is based on the earnings. So this is Lori Calvasina. She's the RBC Capital Markets head of U.S. equity. This is Richard Bernstein, advisors, deputy CIO of Bernstein Advisors, which is 1 billion assets under management. So let's take a listen. There's two little parts to this. Pretty interesting, and it's interesting to note about what's happening with the traditional market and how that is kind of playing into the fact of the cryptocurrency market. Now, there is not a correlation, I'm not saying that, but we can take a look at what different investors are doing as far as retail investors. We can kind of get a look at the overall picture. So let's take a listen.
Period would come, right? We knew that once we got into April, we'd start seeing economic metrics that more fully reflected what happened in the latter half of March. How surprised do you expect equities to be in the coming weeks when we get more of these?
Well, it's interesting. The chatter with people I was talking to yesterday internally and clients, no one really understood why the market had been rallying so much, and that's really been the conversation over the past week is, kind of what were the buyers looking at. So I think whoever it was that was actually doing this buying over the last week or so, they are surprised by this data. But frankly, I think a lot of investors have been expecting us to retest the lows. So I think it's a mixed bag in terms of who's surprised and who isn't.
So are you looking for a retest of the lows, or how much do you think this 50% retracement needs to be unwound given some of the empirical data that's rolling in?
So the way I put it is that I am keeping an open mind about whether or not we saw the bottom on March 23rd, but I'm not quite convinced. And one of the reasons why I haven't quite been convinced is I just don't think we ever got clear capitulation when you look at some of the sentiment indicators we track. And my favorite stat, you look at retail investors, AAII, bears got up to about 52% this time around. Financial crisis, they regularly hit 60% and got up to 70%. And I think that this will go down in history as something more akin to the financial crisis as opposed to just sort of a growth scare, which is where those 50% measures top out at.
Yeah, so here we have somebody, these are two people actually we're going to listen to, that they are in the thick of it as far as the markets, and even they're surprised at the actual bullishness of some of the investors that are out there. Now, is this the market knowing something that nobody else does, a group of people knowing what nobody else does and they're investing heavily, or is it just hubris and people just going off and just saying, you know what, we think it's going to go up because the Fed can just print money and it'll be fine because we'll be okay because the Fed will buy up everything? That really is becoming the question. So let's take a listen to Dan Suzuki, the advisor Richard Bernstein.
Dan, we did see a school of macro desks who did in fact expect us to go back and retest some of those lows, but then they were taken aback by the speed and you could say creativity of the Fed and to a lesser extent Congress. So how much of that ameliorates the case or lessens the case for a complete retest?
I think that all the stimulus helps, and I think they're doing the right things. But I think the bottom line here is that, as Lori mentioned, you haven't seen the things in place that would imply a market bottom here. And I think there's some confusion going on in what you should focus on. I think that when you look for a bottom, you're typically looking for some signs that the economy is getting better or it starts getting less bad. And we're so far away from that with profits and all the indicators crashing to the downside, as we saw this morning. So we need to see signs that even in the...
What he's talking about is when he says profits, he's talking about the earnings report. We're going to see over 900 different companies come out and talk about their earnings over the first quarter, and it's very dismal. It's very, very low about what's happening. And of course it should be because the economy essentially is shut down.
High frequency indicators that those things are inflecting the other way. We're so far from that right now. And by the way, this idea that we're getting this buying opportunity of a decade over a lifetime, it seems far-fetched. But in the market, it's hard to argue that the market is cheaper. The problem is going into this. The market was assigning, the highest multiple in 2 decades on peak earnings late in the business cycle. So when you combine that and you say, what's the potential downside in a correction, you have to take the multiple down to a more normal level, let's just say 15 times. You also take those implied earnings down, because anybody who follows, cyclical companies like, semiconductors or machinery stocks knows that you don't want to value based on peak earnings. So you got to take those earnings numbers down, and when you combine that, it implies that there's still a lot more downside potential in the market. You talked about stimulus, right? But stimulus, it talks about is an attempt to get the economy back to normal. But will the economy look normal, 6 months from now? 6 months from now, 8 months from now. My guess, if you look at, other indications from the medical experts looking at where China is, that we're going to be, 85% of capacity back then. If you told people, forget the next quarter or next 6 months, that, 6 months from now, regardless of what happens now, how bad the data is, that the economy is going to be running at a sustainably 15% lower run rate, that's basically a recession in itself. And that.
Yeah, so basically it's the same thing. Like everything, as bad as it is right now, even as much as the Fed pumps into it and as slow as we're going to get off and to actually jumpstart this economy, we're still going to be in recession. Now the question is, how bad is that recession going to be? Is it going to be one of those recessions like the Great Depression area type recession? Or is it going to be like one of those mild recessions that we've seen before? Only time will tell, but I just look around and I just see people that are out there that are hurting. They are, super waiting for their stimulus checks. That's all they really talk about. And then when they get it, I'm thinking to myself, in America, it's just $1,200, per month. And I could buy a lot of things. But even with that and the Paycheck Protection Program and the EIDL, how much can we really do and for how long? Just is really going to depend. So I don't see anything really kicking up for at least 6 months to 9 months, but we will see. So this is just two different opinions. Let's take a look at the other side of that and look who is actually bullish. It's our friends over at Goldman Sachs. They are abandoning their bearish near-term views on stocks, and they said it was going to be awful, and they said, nope, bottom was in, it's okay. Now, keep in mind, this is on April 13th. The earnings report came out April 14th, and today it is April 15th. So let's take a look at what these guys and gals say at Goldman Sachs. They said, our call of the day from a team of Goldman Sachs strategists led by David Kostin says, the worst of the market rout is behind us. A previous near-term downside of 2,000 for the S&P is no longer likely. Our year-end S&P 500 target remains 3,000, which is plus 8%, said the team in a note to clients on Monday. And I got to tell you, when I heard that, I'm like, all right, they're pretty bullish on this thing. But this is just what's happening right now. It is April 15th, and we saw this huge dip down all the way to 2237. Their original call was it's going to go around 2,000. Now they're saying no, it'll be 28 or 3,000, and we're at 2783 as of right now. So, hey, we might see what happens. But to me, I think it's just people getting ahead of themselves. But I could be wrong. Let me know what you think in the comments section below. But to go even further, this is going to go into TA. And then it's going to go into the cryptocurrency market, and all kind of flows together. So this article was why the recent strength in the market is an ominous sign of what's next. So the market has managed to bounce back decisively from its lows. Don't get too excited. Chris Kimball of the Kimball Charting Solutions says this is a quick burst, or says the quick burst higher could be an ominous sign of what lies ahead. After all, we've seen this kind of action before. In fact, the timing and the size of the market move should be eerily familiar to anybody who's been around a while. Kimball uses this 20-year chart of the S&P 500 to explain why. And this is what I like to see. I like to see somebody who zooms out. When in doubt, zoom out. And this is a chart that took a look at from 2001, actually 2000, all the way up till the present time right now. Let me zoom in. So you can see here in 2001, now remember 2001, that was the time of the dot-com bubble, around 2000, and went from 2002. And you can just see it just grew exponentially, and then bam, came back down. So what did it do? Did a little bit of a pump, and then boom, ba-boom, ba-boom, down and down and down. Next next 5-6 years, everything was going great with the housing market and all the different problems with that. But boy, it went up fast, then boom, it came down. Then a little pump up, no big deal, should be okay. And then bam, down it goes again. And then here we went from 2008 to 2020. That is a heck of a run. All the way up here to the highest points, and then bam, down it goes. And look what we're doing right now. A little bit of a spike. And if history does repeat itself, which it went down, down, up, down, up, down. Same thing here, down. Now, I'm not a big TA person. Maybe you TA people can rectify this in the comments section. Tell me of my ignorance. But that is how I see this chart. So that's what I think. So my final thoughts are this. I don't see this market can recovers while everyone's on a lockdown. And when the ban is lifted, I don't see a future to economic shift for 6 months. If you have the money, you'll get great deals, but a lot of people are hurting right now. So the question to you is, do you think the next cryptocurrency bull run will be by institutions, because it seems like they have all the money in the world, especially getting bailed out by the Fed, or is it the average retail investor like you and me? Which one is going to lead the bull run in the majority? Let me know in the comments section below, and let's move on to how this relates to the cryptocurrency market. So this was kind of a lame article. I'll just be honest with you. Nothing against Benjamin Tamuli. I'm sure he's a great writer, but the subject matter, it was just kind of boring. But the end part was the whole story, so I'll explain in a second. So this was an article and just said that there's a collaborative report between 21 shares and Binance Research identify the performance of traditional U.S. equity and fixed income portfolios with and without the involvement of digital assets. According to the report, portfolio optimization with BNB, amazing because of Binance, was also a major point of discussion. And the whole article can be summed up here. Let me delete this. It is important to note, however, that the large deviation from the ideal BNB allocation of 5% could have unnecessarily given an investor a more than ideal exposure to the crypto market during the early months of the 2018 downturn. So it's saying that, yeah, you can put Bitcoin into your portfolio if you're a traditional buyer, but also what you could have done is put BNB, and you would have done actually a little bit better. And that's the whole thing of the article. And I thought, well, that's kind of great, but it really came down, for me, this was the meat and potatoes of the article. Majority of financial advisors against crypto investments. And contrary to the above, a report by Bitwise Asset Management in early 2020 say that more than half of the financial advisors suggested against cryptocurrency investments. A survey was conducted within 415 top financial advisors in the U.S. And even though they admitted, listen to this, they admitted that 90% of their clients had queried about crypto investments in 2019, the advisors strictly remained against the investment and believed that regulatory uncertainty was a major red flag in this decision. So I see their point here. Well, they don't want to put their clients into something where the whole thing could backfire and a government entity could say, hey, this is illegal, so you can't invest into that, which seems ridiculous because the Howey test has already determined that Bitcoin and Ethereum is not a security. But it leaves things open to as far as outright banning. However, I think that's ridiculous. I'm going to get into that in a second. But if I'm a business owner, if I have people coming, it's all online. If people email me and say, hey, you know what, we really would like to see this service, and 90% of them said the same thing, you bet your bottom dollar I'm going to put that into my online program and say, here you go, and it's this much. Because why wouldn't I? If 90% of the people, but these guys and these gals, they're just like, nope, because of regulatory uncertainty, not going to do it. Let me tell you something. Crypto has outperformed everything just last year by a mile. Let me show you. So here we have, this was by the Binance Research Group. Kind of skewed, but it is true. This is in 2019. It says Bitcoin has outperformed most traditional asset classes since the start of 2019. So here's Bitcoin, here's crude oil, and how's that doing for you right now? Here's tech stocks, U.S. real estate, U.S. stocks, global estates, natural resources, global bonds, U.S. bonds, gold, and agriculture. So, and it should be, I'm pretty sure, correct me if I'm wrong, but I'm pretty sure even the S&P 500 got crushed by Bitcoin. Anyhow, if you see something like this, So let's say, well, first of all, we all know that if we had invested in Bitcoin in 2010, we'd be billionaires, depending on how much we put in. I don't care how much money you put into gold in 2009 or 10, you weren't going to make the returns as far as Bitcoin. So that's a guarantee. Oil, pretty sure it beat oil, pretty sure it beat tech stocks. Well, maybe, maybe not. US real estate, probably. I think it's crushing everything. So if you take a look at this and people are coming to you and you're a financial planner, like, why didn't you put me into this? Especially like 5 years down the road. Can you imagine in 2025, if you go to sit down with your financial planner and you're like, hey, Pete, why didn't you put me into Bitcoin and Ethereum and XRP and BNB and Chainlink and Cardano, all these things? Why didn't you say this? I brought it up to your attention. Just didn't know it was going to be regulated. So we just passed on that. We put you in gold and it went up 4%. So, you're welcome. Yeah, I'd be pretty ticked off. But that's essentially what's going on. So that's one. Two, regulatory clarity is coming. It's coming. It's going to come at some point. I think it's going to be this year in 2020. Let me show you a little article. So first up, the people that are leading the charge for regulatory clarity is Ripple and XRP. And I know some people love XRP. Some people hate XRP. In my portfolio, just so everybody knows, this is what's going on. I own Bitcoin, Ethereum, XRP, Chainlink, Cardano, and EOS. And I've also added Tezos. I'll get into that sometime later. But that is what I have. So if I talk about those a lot, it's because I'm biased. And that's that. So with Ripple, I mean, they're really leading the charge. They actually, not only they expand lobbying efforts, but Ripple, a Silicon Valley-based cross-border payment startup, has opened an office in Washington, D.C. in a bid to amplify its lobbying power. So they are sitting down with the regulators going, hey, let's have a discussion. What do you need to know? How can we help you? Let's make this work. I think they're going to bring the whole cryptocurrency into the limelight. Now, not to get off on a tangent, but I was really hoping that Kelly Loeffler, who was a senator for Georgia, was going to bring that into the limelight. If you don't know Kelly Loeffler, she is the senator for Georgia. She was also the CEO of Bakkt, but she just got busted for insider trading. Not busted. I mean, she said she didn't, so we'll see. But it's a negative mark, and that never looks good. But I always thought that she would be great to go into Congress and explain to those people, hey, this is what's going on with cryptocurrency digital assets, especially Bitcoin. We should get on the ball. But who knows if she's going to keep her seat. We'll see. Anyhow, so that's part of it. And then also in 2020, Congress is going to consider federal crypto regulations in the new Cryptocurrency Act of 2020. This is by Jason Brett. I'll tell you who he is in a second. But just real quick, this is the only part of it. This is just one out of 21 different type of bills that are going to be brought up before the Congress in 2020. 1 of 21. So this one is going to assign a definition of federal digital asset regulator or federal crypto regulator to 3 agencies: the CFTC, the SEC, and the FinCEN, whatever you want to call it. Splits digital assets into 3 different categories: cryptocurrencies, crypto commodities, and crypto securities. The federal crypto regulator is assigned one of the categories and is defined as a sole government agency with the authority to regulate. And so CFTC will be crypto commodities, SEC will be crypto securities, and then FinCEN will be cryptocurrencies. So that is a great thing happening. And I know some people are like, we don't need regulation. That's the whole point of why cryptocurrency was brought in. That's your opinion. I see it the exact opposite way. We need to have regulation so these types of geniuses, financial advisors, can be like, well, it's regulated now, so let me recommend it to all my different clients. I think they should. I don't see what they're dragging their feet for, but whatever. But I'm going to link this in the description below. But the person who wrote this is not Margaret, I can tell you that. Jason Brett. This guy knows what he's talking about. Former U.S. regulator with the FDIC, compliance examiner for the Making Home Affordable program, and the Treasury. So if you want to read a great article and actually take a look at the bill, I'll link in the description below. So that is that. Now, as far as clarity and regulation, this just came about yesterday. Central banks are recommending to ban stablecoins. Central banks push for heavy regulation of centralized, privately issued global stablecoins and consider prohibiting decentralized ones. And the whole crux of it is, given the market's heavy reliance on stablecoin, a ban can mean disaster for Bitcoin and the broader cryptocurrency market. And these are different central banks across the world. So great. I don't really care. Actually, no, I can't say I don't really care. I do care. But I'm going to tell you, this is what's going to happen. The same thing that happened here is going to the same thing that happen in India. This just happened about, what was this, March 5th? About a month ago. India's highest court overturns cryptocurrency trading ban. India's Supreme Court has overturned an almost 2-year ban on cryptocurrency trading that was enforced by the country's central bank. You see the whole correlation there? India, over 1 billion people. Their central banks banned cryptocurrency and cryptocurrency trading. Said, no, you're not going to do that. People rose up, went to the Supreme Court. Supreme Court says you can't do that. And they overturned it. So that's just India, 1 billion people. So if they're going to pull this nonsense here, where they're going to say, we need to ban it, the same thing's going to happen. If they ban it, you're going to have people rise up and say, that's my money, I can do whatever I want with it. How are you going to take away my freedoms? Then it's going to come down to the state courts, Supreme Court, should get overruled. However, do I think this will even go this far? I don't see it going this far. I think people will see right through it and go, look, this just happened in India. Same thing happened over there. Now, what do you think is going to happen? So let me know in the comments below. Do you think that cryptocurrency will get banned globally? I mean, excluding India, of course. Or do you think that this is just an article that they may just be pounding the table, beating the drum, just to see what happens? Let me know what you think in the comments section. And here's the last part. So the third part is, for all these things that are going on, you've got big companies like Fidelity, TD, Ameritrade, and Van Eck, and they're delighted. I'm telling you right now, they're delighted that their competition is passing on this opportunity. It's like going to a gym. A lot of people like to do CrossFit. If you go to like a bunch of gyms and like, hey, do you guys have CrossFit here? No. Go down the street. You guys have CrossFit here? No. You guys have CrossFit here? No. And you keep going down until you find like the only gym in the town that does CrossFit. And the other gym's like, well, I don't like doing CrossFit because, a lot of people get injured. Well, sure. Okay, if you want to play that game, that's fine. We'll take all your customers because we know how to do things right, and off you go. So the same thing here with, you've got Fidelity Digital Assets with 2.46 trillion assets under management. You got TD Ameritrade with 1 trillion assets under management, and you got Van Eck. And Van Eck's a big gold company, or they like to invest into gold, but they just put out an investment case for Bitcoin, which pretty much lays it out as to why Bitcoin is vastly superior to Bitcoin. To gold, excuse me. So with all these things in play, I don't see a problem. I see a problem right now in the short term because of what's going on globally with the coronavirus, with what's going on with the economic downturn, and the Fed printing money. I see great things happening in a year's time, especially with the Bitcoin halving coming up in about 3.5 weeks. But only time will tell. All right, that's it for today's video. So I know that one a little bit long. I apologize. But thanks for sticking with me through the rants. If you like those types of videos, there's going to be 2 more that's going to pop up. One on your left and right. Don't know what it is because YouTube picks them out. They are procured for your pleasure. And that's it. So thanks a lot, and I'll see you on the next one. Bye.